Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, I think I might just take it and run with it. Sure, Steve will find his way back into our little webinar, but I think he might have been kicked out only because I automatically became the speaker tonight, which usually he has to transfer that. So without further ado, I guess we'll jump right into it. My name is Brian Overby. I am the Senior Options Analyst at TradeKing, and I'm here today to talk to you about using the Greeks when trading your FX option contracts. And today what we're going to really get into, a lot of people when they look at the Greeks, they think, oh, I need to learn the Greeks to help manage risk. And yes, the Greeks can be used in that way. And market makers inside and out, market makers, yeah, we did lose Steve, okay, but everybody can still hear me. But market makers are always using the Greeks to try to manage risk because that's what their game is. Their game is you're buying the option, they're selling the option contract, you're selling the option, they're buying it from you. In other words, they're taking positions on that they don't necessarily want to take. They're just reacting to it. So this is how they use the Greeks to try to manage that risk. Sometimes a trade comes in and they have to go out and buy a put option, and they might not be bearish on the marketplace. So what can I do to manage my risk to get myself to be a little bit more bullish on the marketplace? Or how do I turn this into a more neutral trade? Bottom line is we will talk a smidge about how market makers will use the Greeks to manage their risk. But we will talk mainly about how us, and I include myself in this, as retail option traders, use the Greeks when looking at a strategy to determine what Greek is really driving that strategy. And that's an important point that a lot of people, I don't necessarily think as retail traders, we're really over the top looking at, oh, what's my delta risk now? Another hour's gone by. What's my delta risk now on those positions? And we'll define these. We'll walk. We'll start slow, and we'll define delta, gamma, theta, Vega, rho, all the different Greeks, and then we'll go from there. So, all right, that's me, Brian Overby, Senior Options Analyst at TradeKing, and we're very thankful to be able to do this in partnership with the ISE and Steve Meisinger and the whole crew over there at the ICE for asking us to join in and do this. But before we get started, we got to really talk about risk. This is the ISE's disclosure document, I guess. One real important thing before trading options, you must consider the risks of all the tax implications. Any investor should review transaction costs, margin requirements, tax consideration with a broker and tax advisor before entering into any strategy. Prior to buying or selling any option, you must receive a copy of the characteristics and risks of standardized options. Copies have been provided for you today and may be obtained from your broker, one of the exchanges, or the options clearing corporation. We also have our own little disclaimer. For TradeKing, we actually have a link that's available to you through www.tradeking.com/ODD if you'd like to get a copy of the options disclosure document. And then also want to say that we're going to be talking a lot about the Greeks today. So two things that I want to point out. The Greeks represent the consensus of the marketplace as to how the option will react to changes in certain variables associated with the pricing of an option contract. There is no guarantee that these forecasts will be correct. So bottom line is this is a theoretical number that we're going to be using today. Also, talk about implied volatility. It represents the consensus of the marketplace to the future level of volatility or probability of reaching a specific price point, but there's no guarantee that that forecast will be correct either. And multiple leg option strategies might have additional risk and multiple commission and may result in complex tax treatments, please consult a tax advisor. All right, those are the main disclaimers that we got to talk through. Now, this is just a little bit about ISE options, and I'm sure if you're on this webcast, you've probably learned the ins and outs of FX options. But these are some of the different combinations that are available to you that are currently trading. We have the Australian dollar, the Brazilian, the British pound, the Canadian, the euro, the Japanese yen, the Mexican peso, the New Zealand dollar, Swedish and Swiss franc. All right, so the Black-Scholes pricing model. Fisher, Black, and Myron Scholes wrote this back in 1973, actually the year that they first started trading listed options. And basically they said, if you give me some certain variables, we can give you a start to pricing an option contract. And prior to that, there was no really rationale behind why an option was priced at what it was priced at. But these variables, they said, you have to provide us. And here's the variables in the list. And this is a shortened version of the model, but you have the current price, the strike price, the risk-free interest rate, the dividend yield, the time to expiration, the rate of return of volatility. If you give me that information, they can come up with a theoretical price, and notice here it says Black-Scholes price of $2.78. So if I look at this, I see that everything that is in here affects the price of the option contract. So when you're looking at a stock and you go on out and just look at the price of a stock, if the stock goes up one, well, it's very simple to see what would be my profit or my loss if the stock price moved. In the options world, there are many different things that can affect that price. And the stock going up and you're long a call option doesn't necessarily mean that your call option will go up. We need to have a good feel for all the different things that can affect the price of the option. But obviously, the current price of the underlying or the stock is important. The strike price of your option contract. We have cost to carry stuff. I'll talk a little bit about that at the end today. But time to expiration, time decay is a big part of options, and the rate of return of volatility. Every one of these is going to get a Greek letter that will help you to understand if these variables move, what effect it will have on your option. And here's all the Greeks in a nutshell. We have delta, gamma, theta, vega, rho. Delta is the amount an option's theoretical price will change. Now notice, everything's going to say theoretical, so I'm just going to leave that word out. But the amount an option's price will change for a corresponding 1 unit or 1 point change in the price of the underlying security. Delta is obviously very important because we're looking at how my option will move relative to the underlying stock. It's so important that they gave it its own Greek, and that Greek is actually called gamma. And gamma is the amount an option's delta will change for a corresponding 1 point change in the price of the underlying. So delta will tell you how your option moves relative to the stock. Gamma will tell you how your delta moves relative to a 1 point movement in the stock. Then we have theta. Theta is the amount theoretical options price will change for a corresponding 1 day. A lot of times, sometimes they'll calculate a 7-day theta, but most platforms, most pricing models choose to do it on a 1-day basis. But notice it says 1 unit, and that's the reason why they say 1 unit is that it can be calculated for different number of units. Vega is the amount a theoretical options price will change for a corresponding 1 unit change in implied volatility of the option contract, or 1 percentage point change. Rho is the amount, this is the carry cost thing that we're talking about, interest rates and dividends. They do play an effect. It's a very small effect on nearer term options, but it's a much bigger effect on longer term options, and we're going to address that one shortly. So that was just, in a nutshell, exactly what the definitions are of the Greeks. Now we're going to slow down and we're going to define them.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.